I'm Bill Dudley. I'm Vice Chair of the Economic Club of New York and also President of the Federal Reserve Bank of New York. I want to welcome everybody to the 438th meeting of the club in our 107th year. The Economic Club of New York is the nation's leading nonpartisan forum for economic policy speeches. More than 1,000 speakers have appeared before the club, and this has established a very strong tradition of excellence. I'd like to recognize the 214 members of the Centennial Society who have contributed to ensure a sound future for the club. And I'd like to welcome the students here today from Brooklyn College and Law School, Columbia University Business School, NYU Law School, Fordham, and the New School. Their attendance is made possible by our members. We're honored today to hear from Mary Jo White, Chair of the Securities and Exchange Commission. I, for one, am very happy to see that she's at the SEC performing so ably and leading that institution. Chair White arrived at the SEC in April last year with decades of experience as a federal prosecutor and securities lawyer. As a U.S. Attorney for the Southern District from 1993 to 2002, she specialized in prosecuting complex securities and financial institution fraud cases and international terrorism cases. After leaving her U.S. Attorney post, Chair White then became the chair of the litigation department at Debevoise and Plimpton in New York. She earned her undergraduate degree, Phi Beta Kappa, from William & Mary, her master's degree in psychology from the New School for Social Research, and she earned her law degree at Columbia Law School. Chair White, the floor is yours.
Thank you, Bill, very much for that very kind introduction. It truly is my honor to speak before the Economic Club of New York. I also want to acknowledge the presence of two of my esteemed, former colleagues, or at least the agency's former colleagues, Harvey Pitt, the former chairman of the SEC, and former Commissioner Annette Nazareth. It's great to have you here today. I also can't quite resist saying that whoever arranged for the Yankees to sweep the Toronto Blue Jays for my arrival, I will be eternally grateful. So I'm really happy to be here on this particular day. So I may not be able to say that the next time I'm here, so I wanted to say it today. What I want to speak to you about is the current state of our securities markets, an issue that I know is on a lot of people's minds, and one that I think is well suited as a topic for the financial capital of the world where we are now. The U.S. securities markets are the largest and most robust in the world, and they are fundamental to the global economy. They transform the savings of investors into capital for thousands of companies, add to nest eggs, send our children to college, turn American ingenuity into tomorrow's innovation, finance critical public infrastructure, and help transfer unwanted financial risks. The state and quality of our equity markets in particular have received a great deal of attention lately, with a discussion that actually has expanded well beyond those who regularly think and write about these markets to include everyday investors concerned about the investments they make and the savings that they depend on. I have been closely focused on these issues since I joined the SEC about a year ago, and I welcome the broader dialogue. 2 weeks ago, actually just a few blocks from here, I spoke about the SEC's plan to strengthen our current equity market structure and make it more transparent. In addition to outlining a focused review of our own rules and targeted initiatives, I emphasized our commitment at the SEC to comprehensively review and address core market structure policy issues, such as the overall fairness of trading in high-speed markets, changes in the number and nature of trading venues, and conflicts of interest at broker-dealers. Today, what I'd like to do is continue and actually broaden that discussion about these fundamental issues, focusing on actually the changing nature of one of the most basic of securities market functions, intermediation. And at its simplest, intermediation means the services offered by market professionals to execute the buy and sell orders of investors, services offered by brokers, dealers, and exchanges. Just as in other segments of the economy, Powerful forces of competition and technology can transform these services, and they have done so. A central challenge for us at the SEC is to adopt regulatory approaches that ensure intermediaries harness the forces of technology and competition to better serve the needs of investors in each of the markets we oversee, not just in equities, but also in fixed income and derivatives. Now, to understand this challenge, I want to talk first just a bit about why competition and technology are so important to how we address market structure issues generally, and the role of intermediation in particular. I'll then turn actually to contrasting markets to illustrate the complexity of our task as regulators as we and when we grapple with these forces, namely how the equity and fixed income markets have been affected or have not been affected by competition and technology. And just like the U.S. macroeconomy, all of the securities markets operate within a structure of rules, technology, market practices, and other constraints that establish the boundaries for interactions between buyers and sellers. It's important to recognize that this structure does not just mean regulation, but also the much more complex interaction among regulation and other factors like competition and technology. Every incremental change in these interactions can produce significant, sometimes unintended economic consequences that may actually not become evident for a period of years or even decades. So this dynamic reality means that we should not be chasing regulatory solutions that fix the market structure for once and for all. Our markets are not broken, and they are not static. And in that sense, our work on market structure is never finished. The speed with which technology and markets change makes that impossible. Instead, we must always be focused on what in our market structure can be improved for the benefit of investors and companies. And taking this approach actually requires us to expand our perspective, both in terms of time, considering developments well past the last few years, and in terms of markets, understanding the differences among markets rather than simply excusing them as an inevitable consequence of different products and structures. If we stand actually too close to the particular problems in a particular market at a particular time, we may well fail to fully understand the broader forces that are at work and the regulatory choices that are available. So consider the connection that some have asserted between the rise of high-frequency trading and the implementation of Regulation NMS in 2007. Regulation NMS, as most of you know, is the Commission's most recent comprehensive set of rules designed to carry out our statutory mandate to establish a national market system for equities. Regulation NMS includes a so-called trade-through provision that generally prohibits trades at prices inferior to the best quoted prices. Some have argued that this provision facilitated the fragmentation of volume among many new trading venues, enabling high-frequency traders to flourish by exploiting the fastest connection among these venues. Given the current prevalence of high-frequency traders in our equities markets, some put the number, by the way, at about 50% of daily volume, one might reasonably ask, indeed, whether Regulation NMS did in fact change the rules of the game in favor of speed. As a regulator assessing our markets, however, we cannot rely simply on the temporal juxtaposition of Regulation NMS and high-frequency trading. The issues and forces at play are more complex. This can be seen actually in the data from other markets, both in the United States and around the world, many of which are also now characterized by high levels of high-frequency trading, but none of which have their own Regulation NMS. In this light, the rise of high-frequency trading emerges as a more complicated story than simply the unintended consequences of regulation. Take, for example, the E-mini S&P 500 futures contract, which is one of the most actively traded products in the United States and which is not subject to Regulation NMS or SEC oversight. And unlike trading in the equity markets, which is spread among multiple exchanges and off-exchange venues, all trading in the E-mini is centralized on a single market, the Chicago Mercantile Exchange. The CME does not use the pricing structure, you may have heard of the maker-taker model, used by most U.S. equities exchanges. Indeed, in most respects, the market structure for the E-mini is nothing like the market structure for U.S. equities. Yet, empirical studies indicate, very much like the equities markets, that high-frequency trading firms account for more than 50% of E-mini trading. Now, comparisons like, I think this rather basic one, demonstrate the need for really a wider lens in evaluating market structure issues and proposals for changes. That wider lens immediately and inevitably brings competition and technology into view. Perhaps nowhere has the impact of the forces of technology and competition been more profound than in how intermediaries have changed and intermediation has changed over the last 20 years in equities and listed options. At least since 1934, when Congress first mandated regulation of trading in the U.S. securities markets, intermediation has been defined by respective functions of exchanges, brokers, and dealers. Exchanges provide facilities that bring together purchasers and sellers of securities, generally for a specified fee. Brokers, as we all know, are agents. They engage in the business of effecting transactions in securities for the account of others, generally for an explicit commission. And dealers are principals. They engage in the business of buying and selling securities for their own account, and generally are compensated implicitly through trading profits. And some of these dealers are high-frequency traders. Now, to complicate things a bit further, the neat lines that Congress drew in 1934 have not resulted in models of intermediation that are clear-cut or uniform across securities markets. Most obviously, the functions of broker and dealer have often been combined. There is a reason why we call them broker-dealers. The conflict between investors' interests and the intermediary's interests that can be created by this dual role has been a source, frankly, of serious concern since the SEC was created. Another type of dual role and conflict has arisen when exchanges and dealers have acted collectively to control competition among dealers in setting their prices, as occurred in the 1990s. In addition to conflicts of interest, intermediation, when it is unnecessary, inefficient, or uncompetitive, can also unnecessarily increase the costs to investors. The explicit fees charged by exchanges and brokers, for example, may be excessive in the absence of effective competition. Serious concerns have also been raised about excessive intermediation by dealers. So given the importance of intermediation in our markets and the related persistent concerns of conflicts of interest and investors' costs, we must continually rethink the way we look at intermediation. In particular, for a given market, we must ask whether intermediation has appropriately harnessed competition and technology in the service of investors. Are the benefits being realized by investors? Are there unintended consequences that are adversely affecting investors? Is regulation appropriately tailored to the competitive dynamics and technological developments of the market? Stepping back to look at the contrast between actually the equity and fixed income markets may actually help us better understand these questions and the inherent complexities of the regulatory decisions of the SEC. In the U.S. equity markets, competition and technology have had a profound effect for over many years, really generating enormous benefits for investors and issuers. Equity markets today are host to a diverse set of exchanges and alternative trading systems that match buyers and sellers. Dealer intermediation is substantial in both types of matching venues. But many orders are not intermediated on these matching venues. They are being executed by broker-dealers before they ever reach such a venue. Off-exchange trading now represents more than 35% of equity volume, compared to just 25% 5 years ago. And the majority of this volume actually reflects broker-dealers executing directly the orders of both retail and institutional traders. So today, even in the very lively debate about the various aspects of equity market structure, one would be quite hard-pressed, actually, to find concerns being expressed about a lack of competition among equities exchanges and other intermediaries, or that they have failed to take advantage of new technologies. At least with respect to exchanges, this is actually a major change from the past, where a primary concern was for years the potential for dominant markets to stand in the way of forces of technology and competition. This was certainly a concern in the forefront in 1975 when Congress amended the Exchange Act to direct the Commission to facilitate the creation of a national market system. And it continued into the adoption of Regulation NMS, with fears that competition sparked by the new rules would be limited to the New York Stock Exchange and NASDAQ. Well, we're now living in a much different world, where many are questioning whether the pendulum has swung too far, and we have too many venues, creating unnecessary complexity and costs for investors. Over the last 40 years, the SEC has worked hard to further the statutory objectives of the national market system, which include the efficient execution of transactions, price transparency, competition, best execution, and an opportunity for investors to meet directly. But as previous commissions have noted repeatedly, these objectives are not entirely aligned. In particular, the goal of competition among trading venues can lead to what we generally all call fragmentation, where orders may be spread among competing venues. Too much fragmentation may in turn detract from efficient execution and opportunity for investor orders to meet directly by creating opportunities for excessive intermediation. Now, the SEC has sought paths to balance these objectives in advancing the interests of investors. No one, however, could credibly claim that this task is an easy one. For example, one serious challenge arose in the 1990s in the market structure for NASDAQ-listed stocks. Certain dealers on NASDAQ had taken action to discourage competition on quotes and to maintain wider spreads, which helped preserve compensation for the dealers as intermediaries providing liquidity. Institutional investors responded to the increases in their trading costs caused by the wider spreads, finding ways to directly negotiate